Before I move on to talk about purchasing the inventory that we're going to be selling in this company, I need to talk a little bit about the two main ways you're going to keep records of inventory. There are two systems, the perpetual system of inventory and the periodic system of inventory. Now, the perpetual system is just that. You're perpetually, basically constantly updating your inventory records. All right, the best way to do this, and you probably see it all the time, you see it every day and you don't even think twice about it, is if you go to a store, a Target or a Walmart. As you can tell, I use Target a lot. I tend to shop there quite a bit. You go to Target, and what happens? You go to the register, they ring you up, and they scan your product, and you think you get a balanced amount due, you pay the cashier, and you leave the store with your new purchases. Okay, well, you know what? That little scanner part is doing a lot more than just giving you how much you owe as the customer. What it's also doing is it's updating the inventory records. Okay, so every time that little beep goes off as they're scanning the products, inventory records are being updated. So if they had 100 pairs of jeans on the shelves and they sold 3 pairs that day, well, now the inventory records are going to show 97 pairs of jeans. Okay, inventory is constantly being updated. If they get a new shipment in of new products that they purchased to sell in the store, then they're going to update that in the computer system immediately, and all of the records will be up to date. So at any point in a perpetual system, you're going to be able to very easily pull up a number of what your cost of goods sold was for the day, how much inventory do you have on hand, what's the amounts you have. It's very simple. It's constant. Okay, now maybe smaller stores don't have the money or the manpower to have a perpetual system. Now, out where I live, we have what's called little general stores. Okay, it's a very country, cute kind of thing that we have out here. Okay, but these general stores are doing the old-fashioned ringing up of products that are being purchased just very simply with a cash register. Okay, they're not keeping track of how many Twinkies are on the shelves or how many beef jerkies are hanging in the rack. Okay, they don't keep track of that kind of stuff. Instead, what they do is at the end of every month, they count up all of the inventory that's still sitting on their shelves, and from there they're able to determine how many did they sell this month. Okay, what I mean by that is, let's say you start off the month with 20 Twinkies on the shelves. Okay, you have, here I'll even put numbers in for you guys. You have 20 Twinkies on the shelves right now. Okay, so that's your beginning inventory. And you decide, you get a new shipment in of 50 Twinkies. 50 Twinkies purchased. Okay, so purchases. So what you've got is you basically have, that didn't work out quite right. You basically have 70 Twinkies now that you can sell in your store, right? So you would say 70 Twinkies available for sale. All right. So the end of the month comes along, you really don't keep track of how many you're selling, so you don't have no idea what number to use for your cost of goods sold number. You can ring them up all month long, but you don't even know what you sold, you don't know what your cost of goods sold number is. So what you do is you do a count, and you say, well, okay, I had 20, I bought another 50, so I have 70 Twinkies right during the month. Now I do a count, how many Twinkies do I have still on my shelves, and maybe I've got 12 Twinkies. I'm making this hard for myself. 12 Twinkies is my ending inventory. Okay, so how many Twinkies must I have sold during the month? Well, if I had 70 and I now have 12, I must have sold 58 Twinkies. Sold. And that becomes my cost of goods sold number. Okay, so what this is it's really good. It's not even easy. I was going to say, you're constantly counting your inventory, which is a good thing, but it's also kind of a pain as well. Now, just imagine what the inherent problems are here with the periodic inventory system. At any point during the month, you couldn't figure out if your inventory is running low. The only way you would know is if you actually physically went out there and said, wow, we're running low on Twinkies, we should order some more. The other thing that's a problem is you're assuming those 58 Twinkies that are no longer on your shelves must have been sold. What if somebody came in and stole a whole bunch of Twinkies? All right? You wouldn't know. You wouldn't have any idea that those Twinkies had been stolen rather than being sold, because as far as you know, you started off with 70, you have 12, you must have sold those other 58. Okay, so it's not a great record-keeping system. The perpetual system is definitely the better way to go, but it's just simply not manageable for every business to have a perpetual system. Some, it's just simpler to have a periodic system. Okay, so now that you have a little bit of an understanding of how this all works, let's talk about our purchases, all right, our journal entries for purchases. Okay, so let me give myself a new screen. And let's say we're buying some inventory. Let's purchasing inventory. Our purchasing inventory, there's nothing really shocking here. Nothing you haven't seen before. When you buy inventory, you're simply debiting inventory for some amount. Let's say we're buying inventory for $3,000, making up the numbers as I go along here. You're buying inventory for $3,000, and you can either pay them cash, or in this case, I'll just say, rather than cash, I'll say you owe them money, and you've got an accounts payable for $3,000. Okay, now this is us buying the inventory we're going to sell in their store. Now let's just say we've bought the inventory, we have a payable. Now let's say we've got the flip side here. We've got a discount. But now it's the other way of looking at it, because we're the ones buying the inventory. So if we've got this discount, maybe they're telling us we have a discount, and we'll change it just for fun. Discount of 15 and 45. And just a reminder, that would be a 1% discount if I pay within 15 days, or no discount, and I have to pay the full balance due within 45. Okay? So with that, let's say I pay within the discount period. Oops. All right. If I pay within the discount period, I'm going to get a 1% discount. A 1% discount on $3,000 is $30. Okay, so it just happens to be that it works out as the same number as the last one, but basically I've got a $30 discount. So now what this is looking like, if I pay within the discount period, is I'm going to debit my accounts payable for $3,000. Now this is for the same reason that I had to credit my full amount of accounts receivable. I'm never going to pay all $3,000, but I have to take the entire $3,000 off my records. Otherwise, if I only took off the $2,970, which is $3,000 minus $30 discount, if I only took off $2,970, it would look like I had a payable still due to these people of $30, and I'm never going to pay that amount. So I have to take the entire amount of the payable off the books. Okay, I'm going to skip the middle journal entry for a second. I'm going to go right to cash. So the other side of this is I have a credit to cash of $2,970. Like I said, it's $3,000 minus the $30 discount. So the question is what do I have to do to make this balance? Now you might be thinking, oh, purchase discount. But guess what? There is no such thing as a purchase discount. All right? When I have a discount on inventory that I'm buying, my credit is not going to be some sort of discount account. My credit is going to be directly to my inventory for $30. Now you might be saying, what? Why are you crediting inventory for $30? Right? I know you're all shocked. So let me show you a little bit of a T count here for the why I'm doing this. So let's look at inventory for a second. And let me remind you of something. Oops, doesn't work that way. Okay, let me remind you of something. Way back in Chapter 1, we discussed the historical cost principle. And the historical cost principle says I need to record my assets, or my assets for what I originally purchased them for, right? So if I have to record the assets for what I originally purchased them at, my first journal entry for the inventory was me recording it for $3,000. Well, guess what? Did I really pay $3,000 for that inventory? No, I didn't. I ultimately wound up paying not $3,000 for that inventory, but I wound up paying $3,000 less the $30 discount. So the amount I paid for that inventory that's sitting on my shelves was really $2,970. So basically, this here is the discount, and I'm now recording the inventory for what the historical cost principle says I need to record it at, which is the amount I actually paid for it. Okay. So that's if I paid within the discount period. If I don't pay within the discount period, okay, so not within discount period. all right, I don't get any break and I just have to pay I basically just have to pay my bill. Then it would just be a debit to accounts payable for $3,000 and a credit to cash of $3,000. Okay, nothing really shocking or surprising there. Now there is one other thing. What if I decided I wanted to return the inventory? Okay, I didn't want it anymore. It wasn't what I expected it to be, so let's return my inventory. Underline that. If I return my inventory, then your journal entry is very simple. We're just reversing the original purchase entry. Debit to accounts payable, I'm not going to pay them the money anymore, and my credit is to my inventory because I am getting rid of it for $3,000. And that's pretty much that piece of it. Okay, let's continue on one more section here.